It's a bit of a head scratcher, right? You see the market, do this big U-turn, like after President Trump's tariff pause announcement, shoots right up.
Yeah, quite up.
But then, like, in the same breath, you hear short sellers that the folks betting against the market were actually cleaning up in April.
Right. It definitely makes you stop and think, what's really driving things?
Exactly.
And that's kind of the puzzle we're getting into today. We're doing a deep dive into, well, the wild world of market volatility and this whole strategy of short selling.
Okay.
And our guide here is a recent chat with Ihor Dusaniwsky. He's head of predictive analytics over at S3 Partners. It was on Yahoo Finance.
Ah, okay. S3 Partners, they track this stuff closely.
They really do. And this conversation happened right smack in the middle of all this market craziness. So it's a fantastic kind of real-time look.
Yeah, good timing.
Yeah.
So this isn't just theory then. It's about what was happening, like, on the ground as the market was reacting.
Exactly. We've got an expert breaking down how the shorts were positioned, how they navigated that day, especially after the tariff news hit.
Right. So for everyone tuning in, our mission here is to, cut through the jargon, give you a clearer picture of these financial strategies and market swings, make sense of it all.
Okay, so let's start with that apparent contradiction, profitable short selling.
Yeah.
Now, just quickly, for anyone maybe newer to this, short selling is, well, it's basically placing a bet that a stock's price is going down.
Right. You borrow shares, sell them, hope to buy back cheaper.
That's the gist. You borrow, you sell high, hope to buy low, return the shares, and pocket the difference. Simple concept, tricky execution.
So here's the kicker then.
Yeah.
Ihor's data showed short sellers pulled in, $159 billion in profit just in April?
159 billion. Yeah, that's a huge number.
And crucially, that was before that big market jump happened on the day they recorded this.
Exactly. That profit was already banked, which kind of sets the stage for what happened next, that feeling of, well, squeeziness in the market.
Squeeziness. Okay, that sounds like market pressure. You mean a short squeeze?
Precisely. Let's break that down. A short squeeze. Imagine a whole lot of investors have shorted one particular stock. They're all betting it'll fall.
Okay, piled in on the short side.
Right. Then suddenly, maybe some unexpected good news hits, like that tariff pause, and the stock price starts climbing, not falling.
Uh-oh. Bad news for the shorts.
Definitely. Now they're facing losses, so to stop the bleeding, they rush to cover their shorts. That means buying back the shares they originally borrowed and sold.
So they become buyers now.
Exactly. And all that sudden buying pressure just forces the stock price up even faster and higher. It creates this kind of feedback loop, this upward spiral. That's the short squeeze.
Got it. So with the market surging that day, it felt like a squeeze might be starting.
There was definitely that feeling, yeah. And the big question, like Ihor pointed out, was how many of those shorts managed to get out to cover quickly enough to actually keep some of those April profits they'd made?
Because that sudden spike could have wiped out those gains pretty fast if they didn't act.
Oh, absolutely. A sharp reversal can really hurt. And this ties into what Ihor was seeing with some hedge funds, too. He mentioned deleveraging.
Deleveraging. Sounds like dialing back risk.
Yeah, essentially. Think of it like reducing the amount of borrowed money you're using for investments. It often happens when markets drop, and funds get these things called margin calls.
Margin calls, that's the broker demanding more cash.
Right.
To cover potential losses.
Exactly. So some funds were forced to sell assets, reduce their leverage. But interestingly, Ihor noted that other funds were still actively short selling, either betting on more downside or using shorts to hedge their other long positions.
So a bit of a mixed picture then, some pulling back, others still playing the short side.
Right. And then there was this idea of buyer covers in those stocks that suddenly shot up.
What's that about? People just closing out quickly.
Pretty much. It suggests that a lot of the initial buying pressure forcing those stocks up was just short sellers scrambling to cover their immediate bets after the positive news. Once they're done, that buying frenzy might ease off a bit.
Makes sense. The initial panic buying fades.
Yeah, the air kind of comes out of the balloon, unless there's real fundamental strength behind the move.
Now, Ihor also gave us a look at which sectors were attracting more short sellers. This is where it gets really interesting, right? Shows where some think trouble might be brewing.
Exactly. His data pointed to increased short interest in financial services, capital goods, and software and services.
Okay, broad areas. Any specific company names mentioned?
He did give a few in capital goods names like Caterpillar, Boeing, Vance, Verdive, big industrial players.
Right, and financials?
There he mentioned Apollo, Coinbase, PayPal. Even JP Morgan Chase, JPM.
Wow, even big banks. And software and services is obviously huge.
Yeah, covers a massive range of tech stuff.
But here's the twist, wasn't it? He pointed out that a lot of these exact stocks were the ones that just blew out, like shot way up on the day they were talking.
Yeah, that's it. It really highlights that disconnect, immediate market reactions versus these maybe longer-term short bets.
It shows how risky shorting can be day to day, especially with sudden news.
Absolutely, it's a tightrope walk. Even if April was great overall for shorts, one day, one announcement can just flip script entirely. Needs careful management.
So let's dig into that profitable April a bit more. You said Ihor broke down which sectors were the most profitable for shorts then.
He did. The big winners for short sellers in April were energy, semiconductor, semis, and pharma biotech.
Okay, energy makes sense with price swings. Semis have been volatile.
But here's the truly wild stat he shared. In April, 81%, 81 of all individual stocks that were shorted were profitable bets.
81%. That's
It gets better. He said 97% of every dollar shorted was profitable. 97 cents on the dollar, on average. He literally said it was like shooting fish in a barrel, which just tells you how skewed the market conditions were towards the downside, at least for that month.
97% of dollar value. That's almost unbelievable. It really paints a picture of just everything going down, or at least the shorted stuff.
It was an incredibly favorable environment for those betting against the market in April. Makes that sudden jump feel even more abrupt.
Were there any sectors where shorts lost money in April?
Apparently not significantly, no. He said there weren't really any standout bad shorts sector-wise. That profitability was just incredibly widespread.
Okay, moving on a bit. Ihor mentioned something else I thought was really key, the growing use of ETFs for short selling.
Ah, yes, exchange-traded funds.
We usually think of shorting individual stocks, right? But it sounds like ETFs are a big tool now.
They really are. He explained investors are increasingly using ETFs, partly as a hedging tool. He specifically called out equity ETFs like SPY.
That's the S&P 500 tracker.
Right. And QQQ for the NASDAQ, IWM for smaller companies.
Yeah.
But also fixed income ETFs, he mentioned TLT.
Long-term treasuries.
And HYG, which is high-yield corporate bonds, junk bonds, basically.
So instead of picking, say, 10 tech stocks to short, you can just short the QQQ. That seems way simpler.
It's definitely more efficient for many. It lets you hedge against or bet against a whole market segment without managing tons of individual positions. Which brings us to what he called the intriguing stuff happening in those fixed income ETFs.
Intriguing. How so?
Right.
Bonds aren't usually the exciting part.
Well, the activity was he flagged a big jump in short selling there. The numbers were $8 billion in new shorts year to date in those fixed income ETFs.
$8 billion. Sorry.
And get this, $2.6 billion of that came in just the last 30 days before their chat. That's a significant chunk relatively quickly.
Wow. Okay. So quite a recent surge in betting against bonds. Why? Why short fixed income ETFs? It's not like shorting a meme stock.
Good question. He suggested two main drivers. One is hedging. Investors might be shorting TLT, the Treasury ETF, to protect their broader portfolio if they think the Fed's going to raise rates, which usually hurts bond prices.
Ah, like insurance against rate hikes.
Kind of, yeah.
Yeah.
The other reason is just getting exposure. It's an easier way to bet on, say, Treasury yields going up by shorting TLT, or maybe credit spreads widening by shorting HYG or LQD, another corporate bond ETF he mentioned, without actually trading individual, sometimes clunky bonds.
Okay, that makes sense. It's a liquid way to blend views on rates or credit risk.
Got it.
Got it. So finally, did Ihor give the sort of the bigger picture, the overall profit trend for shorts beyond just April?
He did. He put April in context, said that maybe surprisingly, short sellers were actually down about $800 million overall in the first quarter of the year.
Oh, so they were losing money before April.
Yeah. Q1 wasn't great for them, but then came that huge turnaround in April, putting them up $1.3 billion for the year up to that point.
Quite the swing.
Definitely. And he sort of linked this volatility, these opportunities for shorts, back to the market reacting to things like, well, President Trump's policy announcements causing these big daily swings.
Right. Unpredictability creates chances for shorts.
And he also threw in that rising interest rates, mentioning they'd hit 4.3%, could also play a role going forward. You know, higher rates can sometimes pressure asset prices, which could potentially help short sellers.
Okay, lots to unpack there. So let's try and wrap this up. Key takeaways for everyone listening. It seems like, one, short selling can be really profitable when markets are choppy, like we saw in April.
Definitely. But point two, sudden positive shocks, like that tariff news, can trigger painful